Good morning, everybody. Uneducated Economist here. In this video, we are going to be talking about mortgage refinance demand plunging 21%. Now, this is something that is quite opposite of what it is that everybody had felt was going to take place when the Federal Reserve went to cut interest rates. Now, if you had listened to the mainstream media, many economists out there, especially the administration, with Tulay Powell, that if the Federal Reserve was to lower interest rates, it would ease financial conditions, mortgage rates would come down, and people would benefit from this idea. But what happened when the Federal Reserve cut rates? Mortgage rates went opposite. Listen.
Good morning, Andrew. Yeah, the refi boom we saw just a few weeks ago just went bust thanks to higher mortgage rates. The average rate on the 30-year fix for conforming loans increased last week to 6.46% from 6.34%. That's for loans with 20% down, according to the Mortgage Bankers Association. Now, as a result, applications to refinance a home loan dropped 21% last week from the previous week. They had surged much higher just a few weeks ago when rates dropped to that 3-year low just before the Fed cut its rate. This drop
just before the Fed cut rates. This is exactly what happened back in 2023 when the Federal Reserve delivered a message that there was going to be massive interest rates cuts coming in 2024. What ended up happening was a 50 basis point cut and a message that was delivered that there was a weak labor market taking place and mortgage rates went the opposite direction. This is the exact same thing that just took place. The Federal Reserve cut interest rates, delivered it with the message that there was a weak labor market, and now we are finding mortgage rates moving the opposite direction. Now, I have been trying to share on this channel for years now how it is that the Federal Reserve is using their communications as the monetary policy, not the interest rate adjustment, but the communication about that interest rate adjustment. We are finding the results of it now within the mortgage markets. As again, people were believing that the Federal Reserve would cut rates, that mortgage rates would come down, but quite the opposite happens. Now, if you go and you look at some of the things that have been said by the Federal Reserve, this makes a lot more sense. Let's go to Philip Jefferson's speech, February 21st of 2025, because in that speech, sorry guys. Come on. In that speech, he says this: high-frequency asset price data and high-frequency central bank communication data. This research shows that investors' reactions to specific sentences communicated by the central bank are quickly incorporated into asset prices. You see how this worked? Communications, specific sentences by the central bank are quickly incorporated into asset prices. So when she says mortgages were coming down prior to the Federal Reserve cutting rates, that was the reactions from the specific words and sentences that the Federal Reserve was using. Goes on to say this: communications are likely to affect the course of short-term interest rates, other asset prices, and the associated economic outlook, resulting in an easing or tightening of financial conditions. Their communications do it, not their actions, right? They went and eased monetary policy by lowering interest rates, but mortgages went the opposite direction. It's because they are reacting. The markets are reacting to the specific words and sentences that are being used. This is Philip Jefferson talking about how it is that they do that. I'll leave a link down in the description to this very speech. Now, just recently, Michelle Bowman also addressed this, right? And we covered this just recently in a members-only live stream. It says this: I supported revising the characterization of the policy outlook in the post-meeting statement. The post-meeting statement. Revising the characterization. It is important we signal that the last week's actions includes a forward-looking view of additional adjustments. It is important that they signal. This is the Federal Reserve saying it. It is important that we signal that last week's actions, talking about the interest rate adjustments, includes forward-looking views of additional adjustments. People will internalize this. They will internalize it and then use that information. If the statement had not included a reference to additional cuts, it would have signaled to the markets that the committee would not be responsive to weakening labor market conditions. This is how they do it. See, they come out and they deliver a message that will be incorporated into the asset prices. This is what Philip Jefferson just told us in a speech that was delivered about their communication. How they use that communication, specific sentences that are used within the statements. This post-meeting statement had a message delivered with it. They intend to have more rate cuts coming into the future, that they will respond to a weakening labor market. They want people to internalize that information. Okay? Once they have done that, now they have the open-ended communication of being data dependent in order to put more expectation into the market. This is how they do it. I have shared many times on this channel that they are using communication to get a reaction out of the markets. This is an example of it happening right here, right now within the mortgage markets. This is evidence of the credible threat theory playing out in real time. Here, let's take it back again to Philip Jefferson's speech. This was given May 13th of 2024. This is what it has to say in this speech. Sometimes, again, this is coming from Philip Jefferson, voting member of the FOMC. Right? These are the people who are in charge of monetary policy. This is what he has to say. Sometimes central bank communications have unintended consequences. Let me give you two examples. First, there is always a risk that policymakers' statement about their economic outlook or their expected future path of the policy rate are interpreted by the public with a false sense of certainty. Think about the end of 2023. There was a false sense of certainty that many interest rates were going to be taking place throughout 2024. Everybody was convinced of it. Dot plot had predicted all these interest rate cuts. It was a false sense of certainty. Mortgage rates were drifting down after the people were delivered that message. With all these interest rate cuts, they thought for sure the mortgage rates were going to come down. They started acting accordingly. The moment that the Fed cut, they cut with a 50 basis point and then delivered it with a message that says we have a weak labor market. This was in 2024. What happened to mortgage rates? They shot right up right after that. The exact same thing that just took place. The exact same thing. They cut interest rates and delivered that interest rate adjustment with a communication that said that they are going to be facing a weak labor market and that they will have to react to it. Michelle Bowman just said that they had to signal. It was important that they signal that. It's a false sense of certainty that was taking place at the end of 2023 going into 2024. When the Fed delivered the interest rate cut, it came with a message and it sent the mortgage rates in the opposite direction. It had a tightening condition. Specific words and sentences that the Federal Reserve uses quickly incorporated into asset prices and had an easing or tightening of financial conditions, and in that sense, it had a tightening. Their communications leading up to it had an easing of financial conditions. You can see it within the mortgage market. When the mortgage rates come down prior to the Federal Reserve, it's because of the message that was being delivered about interest rates coming down. Easing financial conditions. When the interest rate adjustment took place, it was delivered with the message of a weak labor market, and interest rates, mortgage rates started to move up. This is how they do it. Not through the interest rate adjustments, through the communications, because the communications can have the exact opposite of what the interest rate adjustment is doing. So important to understand. Goes on to say, a data-dependent forward guidance announcement can be mistaken for a commitment to a fixed path of interest rates. When that interpretation is proven wrong down the road, it can create more volatility and uncertainty than if there had been no announcement. You see how the announcement did it? Created uncertainty, created economic conditions within the financial market, easing or tightening it. Communications did it all. Everybody says too late, Powell. Why? No, it's communication that's doing it. It's going to ease or tighten financial conditions. Does the interest rate adjustment have an important effect on the economy? Absolutely. 6 months to a year down the road. There's a lag period that takes place from the interest rate adjustment till the time it actually impacts the economy, but the message is quickly incorporated instantaneously. That is why policymakers always make sure to stress that they are data dependent. They're data dependent of future policy decisions. Always data dependent, leaving it open-ended. Got to wait and see if inflation kicks in, tariffs kick in, whatever. Got to be data dependent. Don't know. Weak labor market. Got to see. Still, historically low, but never know. Data dependent, right? Always data dependent. That way they can keep it open-ended. They don't have to make a decision. If they commit themselves to a decision, the markets will incorporate that. But if they leave it open-ended, now their words have more power. Right? Goes on to say that. That is why policymakers make sure to leave their data dependence of future policy decisions. Second, it is possible that the public misinterprets the views of individual policymakers as a committee view. See, how many times has a Fed official come out and saying, oh, I believe we should have 50 basis point cuts, 25 basis points. They're going to cut, right? And then people hear this one individual or these many different individuals and believe that to be a committee view. The committee view is the entire FOMC voting on monetary policy, and that is a message that is delivered by the chairman, not by individual members. The committee view is being delivered. The message of the committee view is being delivered by the chairman. All the rest of the Fed officials are giving their personal opinions, not a committee view. All right. It is possible for the public to misinterpret the views of individual policymakers as a committee view. The potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. How many times do we hear it? All the time. Myron saying, oh man, neutral rate is going down. Everybody else on the FOMC says neutral interest rate was going up. Many policymakers coming out saying different things at the exact same time. Right? The potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. The diversity of viewpoints among policymakers lends itself to stimulating debate. How many times do we hear it? Administration talks about it, mainstream media talks about it, all these economists talk about it, all these different people talking about what it is that can be happening. It's a diversity of viewpoints. It lends itself to stimulating debate and, as he puts it, ultimately, better policy. How is it better policy? Because nobody is committed to a particular view, and therefore it is open-ended, and their communications will have that much more power behind it. All right? I'm going to leave links to all this stuff down in the description for you. To understand that the Federal Reserve is using their words to guide markets into an easing or tightening of financial conditions is absolutely critical for understanding how it is that you position yourself. So many people were waiting for the Federal Reserve to lower rates so that they could get a better mortgage on their house, only to find out that the better mortgage rate happened before the Federal Reserve cut. Very few people understand this. I get it. The uneducated economist is the only one who has put this information together like I have. I share it with you. The links are down in the description. Uneducated Economist. You let me know.